The U.S. economy enters 2026 with an increasingly difficult-to-conceal paradox. On the surface, macroeconomic indicators still present a relatively stable picture. Growth hasn't collapsed, the labor market hasn't fallen into a technical recession, and the financial system is still functioning. But parallel to this is a series of quiet, highly coordinated actions taking place behind the doors of the world's most powerful central banks. Within 72 hours in March 2023, major central banks, from the US, Europe, the US, Japan, Switzerland, and Canada, collectively established permanent currency swap lines, allowing unlimited access to liquidity at any time. This wasn't a reaction to an unfolding crisis publicly. It was preparation. At the same time, global central banks were buying gold at the fastest pace in over half a century. They are accumulating defensive assets while maintaining the stability of the monetary system and asserting that inflation is only temporary. However, history shows that these institutions never build emergency mechanisms just for show. On a deeper level, contingency structures are being perfected, alternative financial systems that can operate when markets are disrupted, emergency lending mechanisms expanding beyond traditional banks, and system-wide crisis response drills. These are not conventional responses. They are indicators of a risk that the system recognizes but cannot yet publicly name. Meanwhile, the economic life of Americans reflects a different reality: persistently high living costs, ballooning consumer debt, declining savings capacity, and a growing sense of insecurity. The gap between how the economy is described and how it is experienced is widening. The central question isn't whether a crisis will happen tomorrow. History shows that crises are rarely heralded by a specific time frame. The question to ask is, if the system is truly stable, why are its pillars preparing for instability of unprecedented scale and magnitude? And if those preparations reflect a systemic risk, where does that risk lie within the current structure of the U.S. economy? Entering 2026, the way the U.S. economy is portrayed in mainstream channels still revolves around a familiar set of indicators. GDP growth is not in negative territory. Unemployment remains low by historical standards. Inflation, after the post-pandemic surge, has cooled significantly from its 2022 peak. On paper, this is not an economy in crisis. The common argument is repeated frequently: the U.S. economy has had a soft landing. The Federal Reserve's aggressive monetary tightening policy is described as a rare success in its history. Interest rates have risen rapidly but have not triggered a wave of mass bankruptcies. The labor market has not collapsed. Consumption remains strong, at least overall. Large corporations continue to report profits, particularly in the technology, energy, and financial sectors. Financial media emphasizes the resilience of the system. External shocks, pandemics, wars, supply chain disruptions, are seen as having been absorbed relatively effectively. The 2023 banking market fluctuations were described as localized incidents, quickly contained by modern regulatory tools. Confidence is reinforced by the message that today's financial system is far safer than it was before the 2008 crisis. At the policy level, the official picture is also reassuring. The federal government continues to spend heavily on infrastructure, defense, and strategic technologies. Long-term investment packages are presented as new growth drivers, helping to reindustrialization and create future jobs. Budget deficits and public debt, while high, are generally viewed as manageable given the size and unique position of the U.S. economy. In financial markets, stock indices have remained high for several periods, creating a sense of wealth and stability. The growth of major financial assets is often used as evidence that investor confidence remains. The U.S. dollar, despite long-term pressure, remains central to the global financial system, reinforcing the argument that there is no real replacement. All these factors create a consistent narrative. The U.S. economy is facing challenges, but not in a critical situation. Difficulties are described as the inevitable consequences of the economic cycle or a temporary shock, rather than a sign of a structural problem. However, this surface picture has a crucial characteristic: it is constructed primarily from aggregate indicators and average data. GDP measures total value created, but does not reflect how that value is distributed. The unemployment rate indicates the number of people employed, but does not tell the story of the quality of work or the real purchasing power of income. A cooling inflation rate, according to the General Index, does not necessarily mean a decrease in the cost of living for individual households. Stability is described at the systemic level, but it doesn't answer the question of who that system is operating for, and at what cost. As reassuring messages are repeated, while the defensive behavior of central institutions becomes increasingly apparent, the gap between the official narrative and public sentiment begins to emerge. It is in that gap that anomalies appear. People are not adjusting their behavior in the way economic models predict. Small businesses are not sharing the optimism of listed corporations. And confidence, a difficult to measure but crucial factor, is beginning to erode in ways that aggregate data cannot fully reflect. Looking solely at the statistics, the U.S. economy in 2026 might appear to be operating in a new normal. But at the level of daily life, the economic experience of tens of millions of American households tells a different, less concise story, one that is difficult to summarize with averages. Nominal incomes have increased, but real incomes, after adjusting for the cost of living, have been under sustained pressure. For years in a row, housing prices, rent, health insurance, tuition, and food have remained significantly higher than pre-pandemic levels. Even as overall inflation slows, the new price levels have been anchored at high levels, limiting the potential for a recovery in purchasing power. For most workers, especially the middle class and service workers, the issue isn't whether or not they have jobs, but whether those jobs provide enough to sustain a standard of living. Low unemployment rates mask the reality that many households rely on 2 or 3 sources of income, overtime work, or precarious jobs to offset rising costs. Job quality is declining while quantitative indicators remain positive. Consumer debt has become the default mechanism for covering income gaps. Credit cards, auto loans, student loans, and other forms of short-term credit are surging. High interest rates make the cost of servicing debt a constant burden. For many households, paying monthly interest is just as important, if not more important, than saving for the future. People's economic behavior reflects this strain. Consumption hasn't disappeared, but it's become significantly more defensive. Americans are delaying major decisions like buying a home, having children, starting a small business, or making long-term investments. Spending is focused on essential needs, while expenses that enhance quality of life are cut or eliminated. This is not the reaction of a society confident in its economic prospects. The disparity is even more pronounced when comparing income groups. Households owning financial assets or real estate have historically benefited from high asset prices and access to preferential credit. Conversely, those without assets enter a period of high interest rates from a disadvantageous starting point, facing expensive borrowing costs and little room for accumulation. At the local level, the picture is also fragmented. Large financial and technology centers continue to attract capital and labor, while many communities dependent on retail, traditional services, or small-scale manufacturing see weakening purchasing power. Small businesses, sensitive to interest rates and input costs, struggle to stay afloat, although national economic indicators do not clearly reflect this. The key to this divergence lies in the fact that macroeconomic indicators are designed to measure the system's performance, not the economic security of individuals. As the system continues to operate, microeconomic stresses can accumulate without immediately triggering a warning signal on the policy dashboard. Therefore, the prevailing sentiment in American society is not one of erupting crisis, but rather a state of prolonged fatigue. People aren't saying the economy has collapsed, but neither are they acting as if it's healthy. This unease, when widespread and prolonged, creates the psychological groundwork for deeper upheavals that traditional indicators often only reflect when it's too late. The discrepancy between data and reality is not a random error. It is the result of systemic forces that have accumulated over years, even decades. To understand why the U.S. economy may appear stable on the surface but is strained at a deeper level, one must look at how the main pillars of the system are operating. First is the prolonged state of extreme monetary policy. After the 2008 global financial crisis, low interest rates and large-scale asset purchase programs became permanent tools, no longer just short-term emergency measures. This helped stabilize the financial system and support nominal growth, but at the same time distorted asset valuations and encouraged debt accumulation at all levels. When interest rates reversed course and rose rapidly between 2022 and 2024, the burden of adjustment was not evenly distributed. The large system had tools to defend itself, while households and small businesses were directly impacted. Secondly, the fiscal structure relies increasingly heavily on borrowing. Budget deficits are no longer tied to recession cycles but have become a regular occurrence. Large public spending helps maintain overall demand and avoid deep recessions, but at the cost of ballooning interest payments. As interest payments account for an increasingly large proportion of the budget, policy space for social priorities narrows, creating indirect pressure on citizens through taxes, fees, and service cuts. Another structural cause is the financialization of the economy. For many years, profit growth and firm value have increasingly relied on financial techniques, share buybacks, and balance sheet optimization, rather than expanding production capacity or raising wages. This has led to rapid increases in market indicators and shareholder returns, but has not translated proportionally into sustainable income for the workforce. The gap between growth in financial assets and growth in labor income has widened. The labor market also reflects structural shifts. New jobs are concentrated in low value-added service positions or flexible contracts lacking long-term stability. Technology and automation improve efficiency, but the benefits are unevenly distributed. A segment of highly skilled workers clearly benefits, while the majority face intense competition and persistent wage pressure. Wealth inequality is both a consequence and an amplifying factor of these factors. As housing and financial asset prices surged during periods of low interest rates, those who already owned assets entered a new phase with a stronger position. Conversely, those who did not own assets faced increasingly higher access costs, being excluded from traditional accumulation channels. This undermined the resilience of the middle class, which is the foundation of long-term social stability and consumption. Finally, there is an increasing reliance on expectations. Modern economic systems operate not only on current cash flow, but on belief in the future. When policy consistently seeks to prolong short-term stability, risk is pushed backward. This creates a fragile state. The system continues to function, but a sufficiently large shock to confidence can trigger chain reactions far exceeding what current data suggests. These factors do not operate in isolation. They intertwine, reinforce each other, and create a structure in which surface stability masks accumulated tension. Understanding that structure is essential to explaining why defensive signs at the central level are becoming increasingly apparent, even as the official picture maintains a controlled tone. When systemic causes accumulate sufficiently, their impact extends beyond balance sheets or policy decisions. They spread throughout the entire social structure, along slow but persistent paths, altering collective economic behavior and reshaping relationships between groups within the economy. Small businesses are among those most acutely affected. Unlike large corporations, they have limited access to cheap capital, less room to absorb rising costs, and are directly dependent on local purchasing power. Prolonged high interest rates drive up borrowing costs, while rent, insurance, and labor costs do not decrease proportionally. Many businesses continue to survive, but in a state of struggle, limiting investment, delaying hiring, and scaling back operations. At the community level, the ripple effect is manifested in the gradual weakening of local economic ecosystems. As small businesses shrink, job opportunities decrease, residents' disposable income is affected, triggering a vicious cycle of reduced spending. This is particularly evident in areas not directly benefiting from high-tech industries or large financial flows. The disparity is not limited to individuals, it also occurs across geographic regions. The middle class, which plays a crucial role in maintaining economic and social stability, is experiencing a double impact. On one hand, they face high living costs and debt burdens. On the other hand, they witness declining opportunities for advancement and savings. Home ownership, once a cornerstone of middle-class financial security, is becoming more inaccessible to younger generations. This alters the long-term expectations and economic decisions of an entire generation. Collective economic behavior is also shifting towards caution. When enough individuals and businesses postpone spending and investment, a cumulative effect emerges. The economy didn't collapse suddenly, but potential growth was eroded. Sensitive decisions at the individual level, saving more, avoiding risk, produced less positive results at the systemic level. Another less noticed consequence is the shift in the relationship between workers and the job market. Flexibility, once lauded as an advantage, is becoming a source of instability. As short-term contracts and unstable jobs become more common, the ability to plan for long-term finances diminishes. This directly impacts major household decisions, from education to retirement. The ripple effect is also evident in the local financial sector. Regional banks and smaller credit institutions, closely tied to the local economy, are under pressure as customers face difficulties and the value of collateral fluctuates. While the overall financial system remains functional, local stress points may accumulate without immediately being reflected in national indicators. Crucially, these impacts do not appear simultaneously or follow a clear pattern. They occur unevenly, creating a vague but persistent feeling. It is this subtle diffusion that makes crises, if they occur, often perceived first and foremost as a gradual erosion of quality of life and opportunity, rather than a single shock. In this context, risk assessment based solely on averages becomes increasingly inadequate. The system may continue to function, but the social foundation upon which it rests is shifting towards a less stable direction. This is the premise for less discussed, but long-term, issues to become increasingly important. In mainstream analyses, attention is often focused on easily measurable hotspots: growth, inflation, employment, and financial markets. However, it is precisely these factors outside the familiar sphere of observation that determine the system's sustainability in the medium and long term. These are areas where risks accumulate slowly, attract little attention, but when they manifest, they are very difficult to reverse. One group that is clearly affected but rarely mentioned is the working class, who are not poor by statistical definition, but also lack the financial space to withstand shocks. They don't appear in unemployment or poverty reports, but live in a precarious state, separated from personal crises by a medical event, a round of layoffs, or a sudden cost increase. This is a large group, yet it is rarely reflected in policy measures. Long-term risks to the workforce are also often underestimated. As education and training costs continue to rise, while the economic returns of qualifications become more uncertain, decisions to invest in long-term skills are delayed. This doesn't create an immediate crisis, but it undermines potential future productivity, especially in the context of increasingly fierce global technological competition. Another less discussed aspect is the erosion of intermediary institutions. Unions, professional associations, and community organizations once played a shock-absorbing role during periods of economic upheaval. When these structures weaken, the pressure to adjust falls directly on individuals and households. The lack of social buffers allows small shocks to spread more rapidly. In the financial sector, maintaining short-term stability sometimes masks accumulating risk. Temporary deregulation measures, allowing for delayed recognition of losses or asset revaluation, help avoid immediate panic but prolong imbalances. As economic realities and accounting records increasingly diverge, the degree of adjustment needed in the future tends to be greater. The psychological and economic health of society is also an often overlooked factor. Persistent anxiety, even in the absence of an official recession, affects how people make decisions. Fatigue, skepticism, and a sense of loss of control can alter behavior in economically inefficient ways, but this is not reflected in traditional forecasting models. Another long-term consequence is a shift in generational expectations. When a large segment of young people believe they will not achieve a better standard of living than their parents, the incentive to invest in the current system diminishes. This has a profound impact on consumption, saving, and social cohesion. These changes occur slowly, but once established, they are difficult to reverse with short-term policy measures. These factors are often overlooked not because they are unimportant, but because they are difficult to measure and don't fit within the rapid news cycle. However, it is these very factors that determine whether the economy is able to absorb the next shock. When they accumulate long enough, the crisis is no longer a single event, but the result of a prolonged period of weakness. In economics, confidence and expectations are not just auxiliary factors, they are part of the operating mechanism. When confidence is stable, consumption, investment, and hiring decisions proceed relatively smoothly. When confidence weakens, even a system that hasn't yet fallen into a technical recession can operate inefficiently for an extended period. The U.S. economy in recent years has been moving closer to the second state. Americans no longer react to reassuring messages in the way they did in the past. Declarations of a soft landing or sustainable recovery are no longer sufficient to regulate mass behavior. Instead, there is a cautious mindset in which households prioritize saving resources rather than expanding spending, even as nominal income increases. Procrastination has become a prominent characteristic. Major decisions, buying a house, changing jobs, investing in businesses, having children, are pushed back to an uncertain future. Individual decisions may be reasonable in an uncertain context, but when millions of individuals act in the same way, aggregate demand weakens in a way that is subtle in the short term but pronounced in the medium term. Businesses also reflect this sentiment. Instead of expanding production or aggressively hiring, many businesses choose to maintain liquidity, reduce risk, and optimize costs. Long-term investment plans are reconsidered, not because of a lack of opportunities, but because of a lack of certainty about the future economic and policy environment. This reduces the impetus for growth even when financial conditions are not yet completely tight. A crucial aspect of the crisis of confidence is skepticism toward official metrics. When personal experience doesn't align with the narrative presented, people begin to question the accuracy of the data. This skepticism doesn't necessarily lead to extreme reactions, but it undermines the ability of policy to shape expectations, a key tool in modern economic management. Defensive sentiment also alters how risk is distributed. As individuals and businesses seek to reduce their exposure to uncertainty, the burden of adjustment tends to fall on weaker groups, those less able to defend themselves. This deepens the sense of injustice and reinforces the vicious cycle of distrust. More importantly, a crisis of confidence doesn't need a major triggering event to exist. It can persist as a baseline state, where low expectations reinforce themselves. In this state, the economy doesn't collapse, but neither does it recover in the way traditional models predict. Prolonged stagnation becomes a greater risk than even short-term shocks. The role of expectations in this context is crucial. As long-term expectations erode, short-term policy measures gradually lose their effectiveness. Even with room for intervention, the ability to trigger a positive response from the private sector is significantly reduced. The crisis of confidence and sentiment, therefore, is not merely a consequence of existing economic problems. It becomes an independent factor, capable of shaping the trajectory of the economy for years to come. Until this factor is addressed, all other stabilization efforts will have only limited effect. Looking at the overall picture, what stands out is not the immediate collapse, but the prolonged fragility of the U.S. economy. The system continues to function, indicators are still being released regularly, but social and psychological foundations are under increasing pressure. In this context, the future lies not in a single scenario, but in a set of possibilities depending on how current forces continue to interact. The first scenario is a continuation of the status quo. The economy does not fall into a deep recession, but neither does it achieve inclusive growth. Policies continue to focus on maintaining short-term stability, while structural problems are only partially addressed. In this scenario, inequality and the disconnect between data and reality may persist, gradually eroding confidence and growth potential. The second scenario is a more intense period of adjustment, not necessarily beginning with a single shock, but with the convergence of multiple smaller pressures. This adjustment could reveal hidden imbalances, forcing the system to reallocate resources more drastically. Short-term consequences might include slower growth or local instability, but in the long term, it could also create opportunities for restructuring, if managed effectively. The third scenario involves a shift in how economic success is assessed. Instead of focusing primarily on composite indicators, policy and society could shift the focus to the quality of growth, household resilience, and social sustainability. This is the most difficult scenario, as it requires adjustments not only in tools, but also in the way economic goals are perceived. The common thread in all three scenarios is uncertainty. No path guarantees optimal outcomes, and there is no clear timeline to determine when one state will transition to another. What is observable is that current decisions, whether technical or political, are shaping the long-term trajectory of the economy. The open conclusion here is not intended to make definitive predictions, but to emphasize a fact: the economy is not just a collection of indicators, but a system reflecting the expectations, behaviors, and beliefs of millions of individuals. When these factors change, the economic trajectory changes as well. The remaining question is not whether the United States faces risks, but how the system will adapt to existing risks. The difference between sustained stability and painful adjustment often lies not in a single event, but in a series of small decisions made during a period when things were still considered stable.